Welcome to the deep dive. We are just thrilled you're joining us today.
Yeah, genuinely great to be here with you. We have an incredibly complex but vital topic to explore today.
We really do. Because if you've ever looked at the state of the world, seen the geopolitical headlines, and just wondered how on earth you're supposed to navigate the resulting financial chaos, you are in exactly the right place.
Absolutely.
Our mission for today's deep dive is to look closely at this phenomenal piece of source material we have in front of us. It's titled War Economy, Chapter 13.
And it is a dense one, but so important.
Right, and the goal here is to give you, the listener, a complete masterclass in how armed conflict just instantly rewires global money flows.
Because it does happen instantly.
It really does. We're going to examine the surprising economic winners, the unexpected losers, and the long-term ripple effects of war. So by the end of this, you're going to be so much better equipped to understand and navigate an unpredictable macroeconomic environment.
Which is something we all need right now.
Okay, let's unpack this. The core premise of our source material is that war forces a massive, sudden reallocation of capital.
Right.
In a standard peacetime economy, money flows naturally toward what we want, right? Consumer desires, entertainment, travel, luxury goods, new technology.
All the fun stuff.
Exactly.
Right.
But the literal second a major conflict breaks out, that capital is violently redirected away from our peacetime wants and directly into national security. It is an instant systemic reversal of a nation's economic priorities.
What's fascinating here is that war doesn't simply destroy wealth. It fundamentally redirects it.
Right.
When governments suddenly need to fund a massive war machine, they are forced to start spending at a scale that completely dwarfs standard peacetime budgets.
Yeah, the scale is just hard to comprehend sometimes.
It is. And to pay for it all, they can't rely on tax revenue alone. They usually have to print money or issue massive amounts of government bonds.
Which changes everything.
Exactly, because that inherent need for capital instantly expands the money supply, which inherently drives inflation. The prices for raw materials, energy, manufactured goods, they all skyrocket. So if you are a business already operating in those newly prioritized industrial sectors, that wartime inflation translates directly into surging revenues.
It's the ultimate retooling of a society. I actually want to share a statistic from our source that perfectly captures this pivot from consumer goods to the front lines.
Oh, the car one.
Yes, this blew my mind. In 1941, the United States produced over 3 million civilian cars.
3 million?
Right. But for the entire rest of World War II, across the whole country, do you know how many civilian cars were produced?
It's such a crazy number.
Exactly 139.
Just 139 cars.
For the entire rest of the war.
It's a staggering number, and it highlights just how absolute that reallocation of industrial capacity really is. The factories didn't close down, they just stopped stamping out car doors and started building fighter jets, tanks, and artillery shells.
Right.
The source actually notes that between 1938 and 1944, American industrial production essentially doubled in overall size. Yeah, they churned out 297,000 aircraft and 86,000 tanks.
And what stands out in material is that it wasn't just the massive heavy hitters like Ford or General Motors getting in on this.
Not at all.
There's an incredible anecdote pulled from the Ken Burns War production documentary. There was this small business in Connecticut, Mattituck Manufacturing.
I love this story.
It's so good. Before the war, they made upholstery nails, just tiny tacks for living room furniture.
Right.
But when the war hit, they completely pivoted their machinery and started churning out 3 million cartridge clips per week.
Millions a week.
From furniture tacks to ammunition hardware, practically overnight.
Which brings us to a crucial lesson for you listening today. You might be thinking, well, we aren't pausing global car production right now.
Yeah, thankfully.
And that's true. But the core principle, that need for extreme wartime agility, remains incredibly relevant. The small businesses that survive and even thrive during modern conflicts are the ones that can adapt to sudden supply chain disruptions.
Agility is everything.
If a business can pivot its manufacturing or its logistics to fill a newly created gap, they win. The source points out that today there are dedicated avenues like the U.S. Small Business Administration Defense Contracting Program.
SBA programs, right?
Exactly. These actually set aside percentages of massive government contracts specifically for nimble small businesses that can adapt quickly to defense needs.
So agility is clearly the ultimate currency. But let's look at the companies that don't need to pivot, because war is literally their core business model. The defense and aerospace sector.
The permanent winners.
Right. Our source calls them the most consistent wartime winner in all of recorded financial history. We're talking about heavy hitters like Lockheed Martin, RTX, Northrop Grumman.
Yeah.
The historical returns outlined here are massive. Post 9/11, over the following decade, the defense sector surged an estimated 250 to 300%.
While the broader market did nothing.
Exactly. The S&P 500 was essentially flat during that same time. And looking at the 2022 to 2026 era regarding the war in Ukraine, major defense companies jumped another 50 to 70%.
The numbers are undeniable.
But I do have a question about this. When a conflict eventually ends, shouldn't peacetime bring a peace dividend? Why doesn't public pressure eventually force lawmakers to cut those budgets once the immediate threat is gone?
That's the logical assumption, right? But the data shows something economists call sticky budgets.
Sticky budget.
Yeah. When a conflict breaks out, defense budgets naturally skyrocket to meet the moment. But when the fighting eventually stops, the political economy of defense contracting makes it very difficult to shrink those budgets back down to their pre-war baseline.
It just stays up there.
The new, higher level of spending tends to stick. To put the sheer scale of that into perspective, our source notes that global military spending hit an absolute record of $2.2 trillion in 2023.
$2.2 trillion.
Yeah.
It's almost hard to conceptualize that amount of money.
It is. And that money flows directly into multi-year backlogs for these defense contractors, giving them a level of revenue visibility and long-term security that almost no other industry on Earth enjoys.
And those physical manufacturing bottlenecks actually point us directly to the geography of war.
Free.
Specifically when it comes to energy and the Earth itself.
Yes.
Energy is a massive wartime beneficiary. But the source makes it clear that it is entirely dependent on geography. It's
Right.
all about where the fighting actually happens.
Precisely. If a conflict breaks out in or near a major oil-producing region or along a major shipping strait, you get an immediate supply shock.
Everyone panics.
The global market panics about scarcity, and prices react instantly.
The source actually details some major historical price spikes to prove this out. The 1973 Arab-Israeli War triggered an embargo that caused a 300% spike in the price of oil.
Massive.
Then the 1990 Gulf War pushed crude from around $17 up to over $46 a barrel. And the 2022 conflict in Ukraine sent European natural gas to absolute historic highs as pipelines were shut down and supply routes were severed.
But there is a vital piece of nuance here regarding market mechanics that you need to be aware of if you're analyzing the energy sector.
What's that?
Not all energy companies win equally during these geopolitical spikes. There is a massive difference between an upstream oil producer and a refiner.
Oh, because one is pulling it out of the ground and the other is just processing it.
Exactly. When a conflict triggers a supply shock, the price of raw crude skyrockets. If you're an upstream producer, your product just doubled in value overnight without your extraction costs changing.
So it's pure profit.
Pure profit margin.
Yeah.
But if you are a refiner of the company buying that expensive crude to turn it into usable jet fuel or gasoline, you face severe margin compression.
Because they have to buy the expensive crude.
Right, and you cannot immediately pass a 300% price spike down to the consumer at the pump without destroying demand entirely.
People would just stop driving.
Exactly. So the raw material cost rises much faster than the wholesale price of the refined product. While the headlines might say energy is booming, refiners are actually seeing their profits squeezed.
That is such a critical distinction to make when looking at market data. And it's not just oil and gas war has a terrifying hunger for raw materials.
Yeah.
War consumes the earth.
It really does.
Going back to World War II, the American Brass Company alone produced over 2 billion pounds of brass rods, sheets, and tubes.
2 billion.
2 billion pounds.
Yeah.
Just imagine the sheer scale of mining, smelting, and refining required to feed that single machine.
And if we look at the modern equivalent of that resource hunger, the bottleneck has shifted from brass and steel to rare earth metals.
We're at the new gold.
Modern weapons, smart missiles, autonomous drones, advanced guidance systems, they simply cannot function without rare earth elements. And our source highlights a massive strategic vulnerability here. China currently controls roughly 60% of global rare earth production.
60% of the global market. That is a massive choke point.
It is, and it's not just the mining, it's the complex refining capacity. It means that in any future global conflict, securing those specific materials will be a primary objective.
Right.
Which creates massive demand for rare earth mining and processing companies operating outside of that controlled sphere.
And that same geographical vulnerability applies to what we eat. There's that famous Napoleon quote, "An army marches on its stomach.
Always true.
Feeding the military, as well as the civilian populations disrupted by war, completely upends agricultural markets. Looking at this purely from a macroeconomic and supply chain perspective, the source details how the 2022 war in Ukraine severely impacted the global food supply.
The wheat shock.
Yes, the raw market data shows us that Russia and Ukraine together account for roughly 30% of global wheat exports.
30% is a huge chunk of the global diet.
When the invasion disrupted planting cycles, destroyed infrastructure, and blocked export routes through the Black Sea, it caused global wheat prices to surge by over 50% in early 2022.
And an agricultural shock of that magnitude creates a very specific economic ripple effect. Countries heavily dependent on those imports face sudden, severe food security crises.
It's devastating.
It is. But on the flip side of the global market, agricultural producers in geographically unaffected countries like Brazil, for example, suddenly find themselves sitting on commodities that have skyrocketed in value.
Right.
Companies operating across the entire agricultural supply chain, from fertilizer producers to heavy equipment manufacturers to food processors, see their revenues surge as the world scrambles to secure base calories.
Here's where it gets really interesting, though. Because those physical bottlenecks, like rare earth metals and physical supply chains, actually point us directly to where the modern battlefield has migrated.
Yes.
Modern war isn't just boots on the ground or ships in the sea anymore. The modern battlefield is in the cloud. We're looking at a massive shift from steel to software.
The threat environment today elevates almost instantly for civilian infrastructure. When a modern conflict kicks off, the targets aren't just military bases or munitions factories.
What are they hitting?
Nation-state actors immediately target banks, power grids, water treatment systems, global communication networks. The cyber warfare element is constant, pervasive, and borderless.
So if the battlefield is moving to the cloud, how does that shift the flow of defense contracts? Are we seeing traditional defense giants pivot, or is it creating an entirely new class of wartime tech companies?
It's heavily skewing toward a new class of specialized tech. The source highlights specific beneficiaries of this shift. You have companies like Palantir, which specializes in military AI processing massive amounts of battlefield data and satellite imagery faster than humanly possible.
Wow.
Then you have cybersecurity giants like CrowdStrike and Palo Alto Networks seeing their government and corporate defense contracts swell.
Because everyone needs protection now.
Exactly. We also can't forget the physical extension of this tech drone warfare. Companies like AeroVironment are seeing explosive sustained demand because unmanned aerial vehicles are now central to both surveillance and precision strikes.
It's a complete paradigm shift in how capital is deployed for security.
If we connect this to the bigger picture, this heavy reliance on advanced technology exposes the terrifying vulnerability of our modern global supply chains.
Okay, how so?
Take the semiconductor industry, for example. Our source points out that Taiwan produces approximately 60% of all the world's semiconductors and over 90% of the most advanced chips.
90%. That is an unbelievable concentration of risk.
Yes. And it's not like the brass manufacturing of the 1940s where you could conceivably spin up a new foundry in a few months.
Right.
Modern semiconductor fabrication plants cost tens of billions of dollars and take years to build. If a conflict were to disrupt that specific geographic choke point in Taiwan, the results for global electronics, everything from your smartphone to hospital diagnostic equipment to those very same advanced weapon systems, would be absolutely catastrophic.
Which explains so much.
That profound vulnerability is exactly why we are seeing such massive, frantic government investments right now in domestic chip manufacturing.
It's a fragile web. But let's pivot for a second, because we've spent a lot of time analyzing the winners, the defense contractors, the upstream energy producers, the cybersecurity firms. But war is inherently destructive.
Very.
And our source makes it clear that there are massive economic losers when conflict breaks out. Who takes the hit when the capital flows away from consumer desires?
Generally speaking, consumer discretionary sectors are the first to collapse.
Makes sense.
When geopolitical uncertainty spikes, we see a dramatic shift in market sentiment. We enter what economists call a risk-off environment. The consumer psyche shifts, and people immediately cut back on non-essential spending.
The source lists the big ones: luxury goods, high-end restaurants, retail fashion, and airlines absolutely get crushed.
Oh, airlines take a beating.
If you look at the mechanics of it, they are hit by a perfect storm. The cost of jet fuel goes through the roof because of the energy shocks we discussed. Passenger confidence completely drops, so ticket sales plummet, and their actual physical flight routes get disrupted or entirely blocked by conflict zones.
Real estate also traditionally struggles immensely during these periods.
Really? Even far away from the conflict.
Even if you are thousands of miles away from the physical conflict, the wartime inflation forces central banks to hike interest rates to cool the economy down. Those higher borrowing costs put massive pressure on mortgage rates, which cools residential property markets and increases the cost of capital for commercial construction.
It really comes down to a fundamental shift in market sentiment. In a risk-off environment, capital retreats to the essentials.
Yes.
That's why companies like Walmart and Costco historically outperform the broader market during global conflicts. Consumers stop buying the luxury designer handbag, and they start stockpiling basic necessities and bulk food. It's basic human psychology translating directly into macroeconomic retail data.
And we cannot discuss the realities of a war economy without touching on the most somber aspect of human suffering.
Yeah.
War creates an urgent, massive, and tragic demand for healthcare.
The source is really poignant on this point. Every major conflict drives massive, rapid investments in military medicine. During World War II, it was the military's urgent need to treat battlefield infections that actually accelerated the mass production of penicillin.
Which changed the world.
It essentially laid the groundwork for the entire modern pharmaceutical industry.
Mm.
And today, the need tragically continues with high demand for advanced trauma care, complex prosthetics, and crucially long-term mental health treatments for veterans suffering from PTSD.
Yeah.
Companies that supply those specific medical and rehabilitation needs see elevated demand that lasts for decades after the fighting actually stops.
Which brings us to a very practical question for you, the listener. How do you actually navigate this financially? How do you position a portfolio or a business when the macroeconomic environment feels entirely unstable?
Exactly. Investing in chaos feels entirely counterintuitive. What is the actual strategy outlined here?
The very first rule the source outlines is do not panic trade.
Don't panic.
Never panic. The clearest market movements often happen in the initial weeks of a conflict as the market rapidly prices in the new reality. If you try to jump in late based on headline news, you've likely already missed the premium.
Right.
The strategy advocated here is to maintain permanent, diversified exposure.
Okay, how does one do that?
For example, using ETFs, exchange-traded funds, which allow you to buy a basket of stocks rather than betting on a single horse. The source mentions the ITA ETF for broad exposure to the aerospace and defense sector, so you aren't relying on a single contractor's success.
Okay.
And the XLE ETF for diversified energy exposure.
The source also gives a rather severe warning about emerging markets, right?
Yes, absolutely. Developing economies directly involved in or even bordering a conflict zone are extreme risk environments. You are looking at the potential for severe capital flight.
Which is when investors just pull everything out.
Right. They rapidly pull all their money out of a country, causing the local currency to devalue drastically. This often leads to hyperinflation, where the cost of basic goods spirals completely out of control.
So how does an investor actually shield their assets from that kind of inherent wartime inflation, even in developed nations?
The material points toward fixed income solutions specifically designed for this, like TIPS, Treasury inflation-protected securities,
TIPS.
or Series I savings bonds. What makes these vital isn't just that they pay interest, but the actual mechanics behind them.
How so?
Well, with a standard bond, you get a fixed rate, which surging inflation can easily eat alive. But with TIPS, the principal value of the bond actually scales up with inflation.
Oh, wow.
If wartime spending causes the consumer price index to surge, your underlying asset grows right alongside it, meaning your actual purchasing power doesn't get eroded.
So protecting your assets is step one. But looking at the broader long-term picture, our source brings up a historical concept that is vital for everyone to understand if they want to grasp modern economics.
The military-industrial complex.
Well, exactly.
It's a phrase famously coined by President Dwight D. Eisenhower in his 1961 farewell address. He was warning the public about the permanent, deeply entrenched alliance that had formed between government defense agencies and private defense contractors following World War II.
Because all those companies that grew exponentially during the war, they needed to keep making money during peacetime.
Right.
So they developed these incredibly close, symbiotic relationships with government officials to ensure the orders just kept flowing. And like we said earlier, those defense budgets never really shrank back down.
And while Eisenhower was warning about the democratic and societal implications of that permanent war economy from an investment and economic standpoint, it underscores exactly why defense remains a structural, long-term tailwind. The business model became permanently embedded in the government's fabric.
But there is a silver lining to all of this endless military research, and it's honestly my favorite kind of aha fact from the deep dive today.
The spin-offs.
Yes. This military-industrial complex eventually gifts us the most incredible civilian technology. We get these mind-blowing spin-offs. The massive government investments in World War II radar technology
Yeah.
that eventually gave us the microwave oven sitting in your kitchen and the modern air traffic control keeping flights safe.
And look at DARPA, the Defense Advanced Research Projects Agency. Their military research birthed the early internet, GPS navigation, voice recognition software.
It's wild.
Even the Manhattan Project, born out of the desire for the ultimate weapon, eventually led to the creation of the civilian nuclear power industry, which is now crucial for clean energy.
It is crazy to think about how much of our daily peaceful lives was forged in the fires of wartime research.
It really is.
So what does this all mean? Let's bring it all together. If you take away one thing from our deep dive today, let it be this. Wartime economics is a story of radical, rapid disruption. It is the immediate, forceful flowing of capital away from consumer comforts and directly toward national security. It tests the absolute limits of global supply chains. And whether you are a giant defense contractor, a small business adapting to a new market, or just an individual managing your retirement savings, agility is the ultimate currency.
This raises an important question, though. While it is entirely practical and necessary to study these economic patterns so we can protect our portfolios and our businesses during times of crisis, we must also remain critical thinkers.
Very true.
We have to continually ask ourselves how this permanent, ever-growing reliance on defense spending is shaping our global society and our technological progress in the long term.
That is the perfect note to end on, but I want to leave you, the listener, with one final provocative thought to mull over on your own today. We just talked about how military tech like radar and DARPA's early internet eventually became the bedrock of our modern civilian lives. So I want you to look around you right now. Think about it. What seemingly mundane civilian technology currently sitting in your house or living on your phone right now might be silently transforming into the military's most indispensable asset in the next global conflict?
That's a great question.
It's definitely something to think about. Thank you so much for joining us for this deep dive into the war economy. Stay curious, stay agile, and we will catch you on the next one.